Okay, well, thank you everyone for joining us for Monument Crisis Center's Legacy and Tax Planning that Protects Your Family and Values webinar. We're excited to have you this afternoon. We know we'll probably get a few more people logging in to the webinar, but before we get started, I really wanted to set the stage for why we think this is an important topic. I recently reached out to a friend of mine who had retired last year, and I wanted to find out how retirement was for Joe. And Joe responded that sadly and unexpectedly, a good friend of his had passed away. But even more unexpectedly, Joe found out that he was the executor, a trustee of this friend's estate. So Joe had no idea of this in advance. And then he learned also that his friend's estate was quite a mess. So he has been kind of working around the clock to try and help the family and the beneficiaries of this estate through this process. So I know that is not a legacy that any of us are really interested in leaving for our families. We really want to make sure that everything is taken care of. And we have good intentions about always getting around to taking care of our taxes, preparing for our taxes, and preparing for our estates. But it can be a challenge to find that time. So this webinar is to help you kind of make good on your good intentions and really kind of get the basic steps that you need in order to prepare for both your taxes and your legacy, your estate planning. So with that, our agenda today, we're going to do some introductions of our speakers, and then we're going to have our presenters, our great presenters who are very accomplished in their areas, present for us. At the end, we will have questions and answers. So if you have a question as the presentation goes along, feel free to type it in the chat. We will make sure to answer all those questions at the end of the webinar, but we want to make sure that our presenters get to go through their slides before we go to that section, and then we'll do a little conclusion. So with that, though, we really want to let you know also about Monument Crisis Center. In case you're new to Monument Crisis Center, we are the county's largest and uh, most diverse family resource center, which means that we provide wraparound services for low income and at-risk individuals and families. We try and get them to a place where they can have stability, healthy living, and empowerment. So we work hard to provide a variety of services, all for free, all at no cost for our clients. And our 6 core programs include food distribution, resource and referral, health and wellness, youth enrichment, our Senior Moments program, and community engagement and workforce development. We have a lot more information about all that we do here at Monument Crisis Center on our website, so please feel free to visit the website to find out more at any time or reach out. I know you've got my email from this webinar, so feel free to reach out to us to learn more. I want to introduce to you today our 2 key presenters. First is Eve Robinson from the Mitchell Law Group. Eve's main area of practice is estate planning, including wills, trusts, trust administration. She graduated cum laude with a Juris Doctor from Abraham Lincoln University School of Law. She's a member of the California State Bar, as well as a member of the Solano County Bar Association. And then we have Cecilia Lynn, who's a CPA, MBD, and a tax director at Armanino. She's an experienced CPA with a demonstrated history of working in the accounting industry. Cecilia is very skilled in tax preparation, accounting, tax research, and partnership taxation. Cecilia earned her MBT and Master's in Taxation from the UC Leventhal School of Accounting. So I'm very excited for you to learn from both of these women today. And finally, we do have a disclaimer, and that is that this webinar is for educational purposes only. The following information does not or is intended to provide legal, tax, investment, or financial advice. To the extent that you need any such advice or other professional assistance, you should consult with a legal, tax, investment, or financial advisor or other competent professional. So with that, I'm going to ask Eve to come on screen, and chat with us and talk to us about wills, trusts, and estates and how to avoid probate and manage assets during incapacity. Thank you for being with us, Eve.
Thank you very much. Good afternoon, everybody. Um, my name is Eve Robinson with the Mitchell Law Group, as Mary said. I have a disclaimer of my own. I am an attorney licensed to practice law in California, and this presentation is for the purpose of providing information about probate avoidance and estate planning, and is neither intended to nor does it create an attorney-client relationship. Okay, so I attended a continuing legal education course where a judge talked about a silver tsunami of wealth that is being passed to the next generation as the baby boomer generation ages and dies. So the question is, are you prepared? And if not, why not? What are some of the reasons why people don't have an estate plan? Some of the most common reasons are a fear of death, whether you're young or old. People have a fear of death. Procrastination is high on the list of reasons why people don't have an estate plan. Some people believe it's not necessary because they lack enough assets to warrant an estate plan. And some people believe that it's cost prohibitive. We're going to talk about some demographics. In a 2025 study conducted on behalf of Trust and Will called Redefining Legacy, 10,000 people were polled, men and women, old and young, and all ethnic groups. It was found that 31% of Americans have a last will, only 11% have a living trust, but a whopping 55% have no estate plan at all. What is an estate? An estate is defined as one's property, both real and personal, vested and contingent, especially as disposed of by a will. Let's talk about what are your estate assets. First of all, we're going to discuss what's not included in your estate. Not included in your estate are assets held in joint tenancy and community property with right of survivorship, accounts with beneficiary designations, such as pay on death accounts, and assets or accounts that are titled with another person, that would be co-owners. So what's included in your estate? That would be everything else. Community property, quasi-community property. Quasi-community property is property that would have been community property had the spouse been domiciled in California when he or she acquired it. Separate property. So separate property are assets acquired before marriage, assets acquired by gift or inheritance, assets purchased with spouse's separate money, and rents or profits that came from spouse's separate property. Some of you are familiar with separate property, these terms, community property, quasi-community property, or separate property if you have been through a divorce. Let's discuss the plan. First of all, no plan. No plan means that you're in intestate succession that is governed under Probate Code Sections 6400 through 6414, the default provisions for distribution of decedent's estate. This generally involves a formal probate proceeding depending on the value and form of the assets in your estate. Let's talk about what probate is. Probate is a court-supervised process where a personal representative is appointed to administer the decedent's estate by paying funeral expenses, final bills, debts, taxes, and marshaling remaining assets for ultimate distribution to heirs or beneficiaries. Probate can take between 12 to 24 months to complete, sometimes even longer. In 2025, the probate code was amended to allow a primary residence where the decedent lived full time prior to death, valued at less than $750,000, to pass to heirs without a full probate proceeding, but still requires a petition to be filed with the court for approval. This is still time consuming, but not as long as a full probate. So, probate is expensive. If you think an estate plan is expensive, let's look at how expensive a probate is. A personal representative's ordinary compensation for administering a decedent's estate, as set forth in Probate Code Section 10800, the first 4%, the 4% on the first 100,000, 3% on the next 100,000, 2% on the next 800,000, 1% on the next 9 million, 0.5% on the next 15 million, and for all amounts above 25 million, a reasonable amount to be determined by the court. So it should be noted that probate attorneys' ordinary compensation is calculated on the same basis as the personal representative's compensation. Personal representatives and probate attorneys may also petition the court for extraordinary fees if extraordinary services were performed that are outside of the normal probate proceedings, such as filing additional petitions, etc. So the bottom line is that probate is a very lengthy and expensive process that should be avoided. And now we're going to look at two individuals that either had some kind of a will or no estate plan at all. The first one is Aretha Franklin. Aretha Franklin is affectionately known as the Queen of Soul. She died on August 16th, 2018. Her estate was finally settled after 5 years of probate litigation. Two different handwritten letters that are considered holographic wills were found. One dated 2010 and another found between couch cushions dated 2014. Apparently, she did not have a formal will drawn up, resulting in a protracted fight amongst her sons over her estate. Now, a formal will can reduce, but usually does not eliminate the friction among family members over the distribution of your estate. Our next person is Howard Hughes. Howard Hughes died on April 5th, 1976. He died intestate, that's without a will. The administration of his estate lasted about 34 years, finally closing in 2010. His estate was ultimately divided amongst 11 cousins, but more than 600 people tried to claim an interest in his estate. So if you want to have a say in how your estate is ultimately distributed after your death, you must have at least a last will in place. Courts take great pains to ensure that a person's wishes are followed. Of course, in California, a trust would be better, especially if you own real property. Now, we're going to look at the basic components of an estate plan, which include the last will, power of attorney for finance, and a power of attorney for health care, which would be an advanced health care directive. Next, we're going to look at what a comprehensive estate plan includes. Comprehensive estate plan is for probate avoidance and management of your assets during incapacity. Should you become incapacitated, your successor trustee can manage your assets through your trust, which will likely avoid the necessity of having a conservator appointed by a court to manage both your person, which would be your medical decisions, and your estate, which would be your finances. So a comprehensive estate plan includes a trust, a pour over will, a power of attorney for finance, power of attorney for health care, general assignment, certification of trust, any transfer documents to transfer your real property, such as deeds, and then any assignment of business interests to your trust. Next, we're going to talk about gifts to charity. This is Joan B. Kroc, who died on October 12th, 2003. Her estate was worth $1.7 billion as the date of her death. Miss Kroc was extremely philanthropic, and through her last will, she devised millions of dollars to public radio, universities, and other charitable organizations. She left $1.5 billion to the Salvation Army to build community centers in various working class neighborhoods throughout the United States. The funds were to be distributed over several years, and their use was limited to construction costs and an endowment for operating costs of the community centers, but they could not be used for existing programs or administrative overhead. Although the Army greatly appreciated her gift, limiting its use to a specific purpose made it impossible for the charity to use it to continue its primary mission of, quote, preaching the gospel of Jesus Christ and to meet human needs in his name without discrimination, unquote. So the moral of the story here is if you want to make a charitable donation through your estate, through your estate plan, it may be a good idea to understand the charity's mission and allow the charity to exercise its discretion to use the funds where most needed. And lastly, I would like to encourage you to visit the California State Controller's Unclaimed Property website to see if you have any property being held by the state in your name or your deceased loved ones' names. I found that the state was holding property worth several $1,000s in my mother's name, so I submitted a claim on behalf of my sisters and me. Okay, so that's going to conclude my presentation. I thank you very much for listening.
Thank you, Eve. That was great. That was great. And now we're going to move on to Cecilia, who is going to be presenting for us on taxes. And Cecilia, we'll just get to your slides in just one second. There we go.
Hi, everyone. I'm Cecilia Lane, Tax Director with Armanino in our San Ramon office. Thank you, Mary, from Monument Crime Center, to including me for this presentation. I think that the attendants who signed up today is a good start. Always saying that nothing happened without a planning. How you maximize your tax takes time. So your initiation today will make a difference. So hopefully I will do some brief explanation, definition, and maybe some advice. Hopefully, if you have not filed your 2025 tax return, which you probably have extension, that will benefit your last year tax return. But most important is current year, what you can be done, will be doing, that will hopefully help you to save some tax here. So in the background for the current tax law is probably you already hear about called the One Big Beautiful Bill. We call the OBA. That's cover a lot of area that changes the tax law. But today we are focusing on two areas. One is the charitable donation. The other area will be the kind of like a retirement income, how you get the tax deduction or benefit out of it. So again, the OBA is a policy change, and there's a different changing on the limit, the income threshold, the strategy that impact almost everyone. There's just a different level of percentage changes. So now I think it's time for you really to revisit the what impact you. So especially now, again, I'm talking about, giving, sometime related to, the donation. So will be the investment and also the retirement area that could help a little bit if hopefully, again, we can't emphasize enough is planning. And we are putting the phrase here, every move matters. So as a tax advisor or, a tax preparer, we often give clients like, hey, you do what you're doing, but at the back end, it's like the planning part will make a difference. In here, especially for the charitable giving, how that will impact your deduction. And then, probably not just for 1 year, some of them will be we call the ripple effect, maybe for the next 5 years. So next, we'll talk about, some of the, charitable giving strategy. Maybe some of you probably already doing, right? I, give to the church every week, writing a check or even outside the grocery store, Salvation Army, you put some money in there. But I think here we probably talk more about really the money that you're giving, how really impacts you in the income tax return. So sometimes we call the approach. Maybe there's events going on, and maybe there is a family. You have a designated charity that you guys are really falling into and have a plan. If talk about the estate part, my area probably talk about is doing a lifetime, the income tax effect rather than the estate part. So there's a reasonable kind of like a thinking to say, okay, what if I'm doing something different to make the tax effect more powerful in a way? So there's also an opportunity that in the current year, again, most of them probably you donate a cash. Typically, that will be subject to 60% of the adjusted gross income. Let's say you have adjusted gross income, basically it's like a total income like $100,000. The maximum you can deduct is 60%, which is like 60,000. That's the maximum. Anything left over, you don't be afraid like you lost it, but no, it can be carried forward for the next year to use. So for current year, if you're in the highest tax bracket, any dollar you donate, basically you can save you, we call the marginal tax bracket, the tax rate, the highest is 37%. So it's pretty impactful, like, consider, the donation part. However, when we say how you like make the opportunity that will make it a big impact on your return, that will be depending on your income level, right? Or you have enough, we call itemized deduction, or you are in a standard deduction category, which means you probably don't have any property tax to deduct, any mortgage interest that to be deducted. For those type of taxpayer, we call you like, you're under a standard deduction. For individual, like single filer, for 2026 could be up to $16,000 without doing anything. You get automatic standard deduction for $16,000. And for married filing jointly, you probably get $32,000 without any itemized deduction. However, the OBA, the new tax law, even you don't benefit from the itemized deduction, you can still deduct called above the line if you happen still making a donation to the church, right, to the charitable organization. For single, you can still take the deduction up to $1,000 for single filer, and for married filing jointly, you can deduct up to $2,000. So that's still a benefit, because sometimes I felt like people make the donation, but you don't get the tax deduction. We just felt like that's just a waste of the tax saving. So we always want to make sure that every dollar you donate, you get some sort of the tax benefit. So this change of the tax law will benefit you. Even as we call it non-itemized taxpayer, you still get some sort of a benefit from the making a cash donation. The other area is, again, is the timing. So even though most of the taxpayer comes to us is like at the year end when we're doing a year end planning to see what's your projected income to be, right? So, and then it's like, okay, what can we do? typical taxpayer comes in with, you're just a employee, right, getting a W-2, and then some of the 1099 from the investment. So that's a kind of like a typical taxpayer, income. And then what can you do to reduce the tax? Charitable contribution probably is the one I call variable that you can make a difference. So the next slides, we'll talk about how, what type of like uh, assets that you can donate. So even though the headline here is like after you die, but during the lifetime, you can still donate this type I call the non-cash contribution, which sometimes make it more incentive to do it. The reason behind is just for the first example, the stock or bonds, basically I call it investment, because when you have a highly appreciated stock, just say if you happen to have a share of Nvidia, right? And now compared to a couple years ago, it's already probably 100%, even more rate of return. So if you happen to, own those highly appreciated stock, Apple stock, or, those SP 500 stock, then if you consider donate those stock, you are basically saving the capital gain that what if you sell those stock and need to recognize those capital gains. So you need to pay tax on it. But rather than doing that, you donate those stock to the charity that you can deduct basically the fair market value of those stock. Let's just say the Apple stock when you buy it is $50. Now it's like $200. And then you can deduct $200 and then without even recognize the $150 capital gain at all. So that's the merit of why people, donate the stock to the charity. The second part of it is we call the real estate or the real property. That probably sometimes have a significant meaning. People probably, donate certain property for a charity for their purpose of maybe they need a venue to do something. Recently, I went to, other organization in the area. There is just simply like a residential home, but turns out it's a venue for a local club gathering, hosting an event. So those, and they always have a pledge like this, probably donate by, who's. So those sometimes is the intention. And then of course that will come up with what you need to be done, right, before doing that. For real property, you always have to have appraiser to, go to your house and assess the fair market value for the day of the donation, so that you can claim the deduction. But also, when you file the return, you will need to provide the appraisal report when you file the return as well. Same as the fine art. The fine art, sometimes we call it collectible. So it will be the same thing that get the qualified appraiser is the key thing to determine the value. And they will need to give you the report, basically in order for you to claim that fair market value, what's that worth, to claim that fine art. So these are the area that kind of like, okay, cash kind of like an easy one, right? You just write a check or even, give the cash out. But if you consider like a non-cash, then basically other than publicly trade stock, then you're okay. But other than that, you will have to kind of like get some sort of like appraiser for the value. Then we probably switch to another, probably now before we kind of like all the donation deduction area. And then now we kind of like shift a little bit to focus on tailor to those people at the age of 73, basically enjoying your retirement right now. However, you still need to pay tax, which a lot of my older client, they just always complain, oh, I get all this, why my tax is going up every year. So first, we want to give you some sort of like a definition. If you are about, that age, it's called the RMD, require minimum distribution. So hopefully, if you're already, getting those income and there's something you can do. So R&D again is the minimum distribution you need to take out from your retirement plan account, which is IRA, simple IRA, SEP IRA, not the 401k. So it is when the time you hit 73, then you need to start withdrawing the money. Otherwise, you will be penalized. So the way RS, the calculation or the formula, people, my client, how to calculate those amount. basically, ours assume everyone will live up to 100 years old. So when you're 73, basically is whatever the amount of the retirement account balance, and then will be divided by 24 as your first year, because 100 minus 73, I'm sorry, is a 27. And then every year will be, your denominator will be reduced. And if the market happens to be a good one, right, your balance just keep growing, and then your subsequent year distribution actually be increasing. So one of the thing, of course, you can always make sure you have enough withholding, right? Mark the form to make sure they, sometimes will withhold, right, 25% of the federal tax, or 10% for the state. Or the next box in this slide we say is a qualified charitable distribution. For me, I think this is a huge make big difference. If you already, right, a regular donor to your charity, this is the one thing you have to have. Make sure that you fully utilize it. Otherwise, I just feel like it's a waste. So this is a huge thing. If you never heard about, just make sure remember this acronym QCD. So what QCD do is you instead of like donate directly to the right to all the charity, the church, or whoever the charity is, the the retirement plan, those money sitting in, let's just say Fidelity, they will make the money directly for you, directly the money transfer from your IRA account to the public charity without you touching the money in a way. So that's the mirror of that. And then the maximum per person for a single year is $108,000 per person. And if you're, married filing jointly, a couple can up to 216,000. So that's a huge. The reason it's huge is anytime you can reduce your adjusted gross income is a key thing. You want that because adjusted gross income determine a lot of, the threshold, the haircut is based on adjusted gross income. Anytime you can reduce that is a plus plus. So you just have to do it. If you haven't done it, please do it. For myself, what I encounter is I have a lot of, again, older taxpayers, senior, and sometimes, they just love writing check to all the mail they get into different type of charity. So it's a long list. They just keep writing, writing, writing. Sometimes you lost track. Sometimes we have to spend more time to take out the bank statement to find out. In this method called the QCD, which basically your, investment the advisor, they already will, give you a ledger for the amount they pay on your behalf. So you don't really need to keep track of those anymore. Plus, it's already, reducing your income. So kind of like it's just administration, I call administration cost because you need to spend time to summarize all, then it's gone. And then you get this reducing of income, which is a huge, huge thing. So just again, if you haven't looked into it, QCD probably is a key thing I would highly, highly recommend. It's one thing that if those retirement people that haven't thought about this is one thing, I call no brainer. You just have to do it. So to summarize, really the key takeaway is yes, there's a lot of changes. Tax law comes in, but again, for a individual, is what applicable to you. So whenever you have I call a year that have a transaction going on. Typically, if people thought about, probably you heard about, hey, converting your IRA account to a Roth IRA means when you withdraw it, there will be no tax and you're not subject to RMD, require minimum distribution. But when the year that you do a conversion, that is a taxable income. So how you can do that? Maybe increase the charitable donation to offset those. So, or if you happen to a stock option, let's say you want to exercise those, generating some, capital gain, how can I reduce my tax? Maybe it's a year that you want to do a donation. And there's a strategy for donation that another area that sometimes people will say called the donor advisor fund. That sometimes people will say that is because you may not have a charity that you already know you want to make the donation. So this donor advisor fund, which means typical people will put in the stock donation in there, and then you can, take the value, the fair market value that you can take for the deduction, but you have 5 years to think, to decide which organization you want to donate. So stock donation, probably just like I said before, is only up to 30% of your AGI that you can deduct. Cash is 60%. So there's a limitation that you probably want to make sure that does it benefit you the most. So again, as a tax advisor or preparer, we often run into this scenario to give client to see how much you want to donate to max out your current year tax benefit, because in certain different year your tax bracket could change, because certain year you may have a higher income, your bracket is upper, but certain year you have a lower, then will be different. But in general, like it's a good thing to, if you have this intention, always talk to your tax advisor. Hey, what do you think if I do this? I just got a call from my client. He want to donate his Springler van from Mercedes-Benz, which he put in additional 230,000, and he's no longer using it, and asked me, can I make a donation for it? What can I do? Like, how should I do it? Do I have, what's my income going to be? Does it make sense? What's my benefit of it? So those type of a typical question that I will get, and if you happen to receive something that, hey, you want to donate, I'll reach out to a tax advisor to seek their advice and give you an option what's the best way to do. Again, cannot focus enough on this qualified charitable donation in our last line here to reduce your, again, R&D, which you just have to take it out the money, other than, if you have a Roth IRA. But there's just things can be done. Again, planning is the key. Today is May 12th. You still have less than 7 months, to think about, what's your upcoming income going to be and what you can be done. So there's still time. So don't wait until December 31st to, I have this amount of tax due. What can I do? By that time, as a tax preparer or tax advisor, we can't really do anything, because the clock is ticking. December 31st is the end of the year that you can't really do anything. So be proactive, do the tax planning. Again, if you have a question, here's my contact, feel free to reach out. Hopefully, this little webinar can just, if you haven't have a thought about tax, donation, or RMD or QCD can have the tax impact. Probably today is the day to start thinking about it and correlate it with, the estate planning, your will and your trust, and just make your life hopefully easier. And of course, for, maybe the family or whoever the benefit from the estate, that will help. So
Well,
that's
thank
my
you.
presentation.
Thank you so much, Cecilia. Thank you, Eve, very much. This is great information. I really, again, think it will help our attendees and those who watch this webinar in the future to make good on their good intentions of being prepared for their estate and prepared for their taxes. Well, thank you, everybody, for being with us today. We're really grateful. Again, if you want to learn anything more about Monument Crisis Center, please just go to our website, or you can reach out to me. And Eve and Cecilia, we are really grateful for your time and energy that you put into doing this great webinar. Thank you very much.
Thank you, everyone.
Thank you,
Bye.
everybody. Bye.